The spring budget has brought in some big changes, especially to pensions and childcare. I'm going to run you through the headline figures, but I also want to explain the new tactics that you could use to maximize tax efficiency and make the most of the new benefits that are on offer. There is quite a lot of upside in this budget, but before we get into that, it is important to note that we are still witnessing one of the largest stealth taxes in history. When inflation is high, governments can raise taxes by doing nothing. By keeping income tax bands unchanged, inflation is going to push more and more of our income into higher tax bands, which have been frozen until 2028, which means that almost everyone is going to end up paying more and more tax. But it does seem like there might be some relief in sight, with the OBR projecting that inflation will fall to 2.9% by the end of the year. Obviously, this may not happen, but if it does, we could expect interest rates to follow suit and relieve pressure on those refixing mortgages. Now, on to the upside, starting with pensions. Before 2006, there was no limit on how much you could put into a pension each year. But since then, there has been an annual allowance cap that restricts how much you can put in. After having been held steady at £40,000 for many years, this allowance is set to increase to £60,000 per year. In 2006, a pension lifetime allowance was also introduced that meant that if your pension grows above this limit, you could face up to a 55% tax charge on the excess. This limit started off at £1.5 million, it increased and then decreased to where we are today at £1,073,000. For next year, the lifetime allowance charge is going to be removed and then completely abolished. So there is now no limit on how large a pension can grow. So does this also mean that there is now no limit on the tax-free cash that you could potentially draw? Unfortunately not. The maximum amount of tax-free cash is being fixed at 25% of the current lifetime allowance, or £268,000, and this will not rise in line with inflation. So once you have drawn down this amount of tax-free cash, the rest of your pension will be taxed at your marginal rate. Changes have also been made to pension annual allowance tapering. Previously, once you started to earn over £240,000 per year, your pension annual allowance started to be tapered from £40,000 down to just £4,000 per year. From next year, the point at which this tapering starts has been increased to £260,000, and the maximum taper has been increased from £4,000 a year to £10,000 per year. This change will not affect many people, but I know from experience that most people that earn this amount of money are not aware of this rule and are facing large tax charges each year simply due to the default contributions that they are making into their employer's pensions. Once you reach 55 and draw down on the taxable part of your pension, you will trigger the money purchase annual allowance that sets a limit on how much you can then put back into a pension if you were to start working again. Previously, this was set at £4,000 per year, but the government thought that this might be restricting people from returning to work, so the limit has now been increased to £10,000 per year. So these are the changes, but who are they going to affect, and what action might you need to take as a result? Well, firstly, the £4,000 annual pension allowance has not really been restrictive to anyone until this year, where many doctors have been handed large tax bills because their NHS pensions have had inflation adjustments that have pushed them above their annual allowance, leading to many doctors, including several of my clients, to reduce their hours or stop working entirely because it is no longer tax efficient. The increase in this allowance and the fact that inflation is likely to fall should help to prevent this from happening in the future and keep more doctors in work. Again, the pension lifetime allowance was only ever a problem for a handful of people, but since this allowance was due to be frozen until 2026, inflation was going to put millions more people at risk of hitting this limit. Now it's being removed, so you no longer have to worry about saving too much into your pension or being penalized for good investment performance. Yes, beyond a certain point, you won't get any more tax-free cash, but it's likely that the tax relief that you get when putting money into a pension will still be higher than the tax you pay when you take it out, especially if you plan on leaving your defined contribution pension to other family members on your death who are likely to pay a lower rate of tax, which means that a pension is now, more than ever, the best tool you have for building wealth and passing it on to future generations. So when it comes to pension contributions, it is important that you do what you can each year, but you also might need to be tactical with the contributions that you make, especially if you have children. When you make pension contributions, it reduces your taxable income, which can be useful to gain or maintain certain means-tested benefits. Firstly, if you are in receipt of child benefits, once a member of your household earns over £50,000 per year, this benefit starts to be clawed back. But you can then make tactical pension contributions to bring your taxable income below £50,000 and reclaim this benefit. Secondly, one of the biggest announcements in the budget was the extension of free childcare. Currently, parents with a child aged between 3 and 4 can get 30 hours a week of free childcare, which, depending on where you live, could save you up to £15,000 per year. But over the next 18 months, this is set to be extended to any child over the age of 9 months and under 5. This is a huge benefit to parents that could save you £50,000 per child. But if you or your partner earn over £100,000 per year, you won't qualify for this benefit. But again, you can use pension contributions to bring your adjusted income back below £100,000 and regain access. For every £2 that you earn over £100,000 per year, you lose £1 of your personal income tax allowance. So if you were earning £125,000 per year, you could make a £25,000 pension contribution, and you would not only get £15,000 worth of free childcare, but you'd also reclaim your personal income tax allowance, giving you 60% tax relief on that pension contribution. What's more is that given that the pension annual allowance has now been increased to £60,000, it means that anyone that earns between £100,000 and £160,000 can use pension contributions to reclaim these benefits. In fact, if you earn more than £160,000, you could carry forwards unused allowances from past tax years to get you back down to 100k. You could even deliberately avoid making pension contributions in prior years, knowing that in the future you will need to make large pension contributions to reclaim these benefits and maximize tax efficiency. All of these changes are ultimately good for pensions, but what if a future government comes in and moves the goalposts yet again and changes these benefits? Well, there is no doubt that there will be changes to pensions in the future. That is the only thing that we can be certain of. But if you are going to play the game of speculating on the results of future elections and the policies that future governments may or may not introduce, you are only going to tie yourself into knots and never be able to make financial decisions. So it's important that you play the rules as they are now, with the knowledge that when rules have changed in the past, like when they initially introduced the lifetime allowance, or when they've been increasing the age at which we can access our pensions, they have also added in protections so that those who are already at those limits or about to hit them have not been adversely affected. But whatever changes do happen in the future, I will still be here to help you understand what they mean and what action you might need to take. So if you haven't done so already, please do subscribe and let me know if you have any questions about the budget and how it may affect you personally down in the comments, because I will be glad to help. I'll see you soon.